Perhaps, Mark, let's start off with you. 13% increase in revenue, 15% increase in headline earnings per share, and that from continuing operations. But overall, that 4% decline coming through on a headline earnings per share basis. And really, it's the trading losses that are filtered through from African prepaid services Nigeria via Multilinks that has come to bear here, right?
That's correct. We were very happy with our results. Our growth in turnover has been a significant growth. We managed to outgrow what the networks were growing at between 5 and 6%. So from that point of view, I think we've done very well in implementing our strategy. Unfortunately, we've had a setback in Nigeria. And if you strip that out, our growth was, 15% rather than the negative 4%.
Taking a look at that, that impairment level right now, it's not just Multilinks, the impairment stretched beyond that. Are these all to be considered as once-offs for this earnings report?
100%. I think what we did is took a conservative view to impair everything off. So market shouldn't expect any more. And yes, there's once-off for sure.
Well, thank goodness you've had something to offset those kind of impairments, and that coming through from Blue Label Mexico, $20 billion being received for your stake in that operation. You've diluted your shareholding there to 40%. Run us through the rationale there and what this now opens up for you in terms of growth moving forward.
I think really important for us is to find strategic partners around the world where we go. And the partner that we have found in Mexico is a group called Grupo Bimbo, the largest distributor of bread in the world, or bakery in the world. Really touches around about 3.2 million distribution points on a daily basis. So a really great place for us in Latin America as well as Mexico. So our product complementary with their product is a really great distribution channel and really exciting for us in Mexico.
Of course, overcoming challenges, one would assume, of overheads and infrastructure that surrounds a distribution network itself. Let's take a look at the kind of market, though, that you're catering to in that arena.
In Mexico?
Yeah.
Well, if you look at Mexico, primarily a physical distribution environment, with our new partner, they distribute to hundreds of thousands of physical points of presence. So with our proprietary technology, we're able to now digitize virtual distribution, for example, airtime or milk coupons or remittances. So it creates a very significant opportunity for us to increase our points of presence by literally thousands of points through the partnership that we have created.
That's particularly interesting where, when you go through some SWOT analysis done by the industry, one of the weaknesses that is highlighted is the fact that you've still got 91% off your revenue coming through from South Africa. So run us through your refocused international segment, because it extends beyond Mexico. You've got Oxygen Services India also now starting to contribute a little bit more to it.
I think our focus has generally remained the same for the next 5 years, which is to have 50% of our profits come outside of the telcos and 50% from telcos. And I think more importantly, for 50% of our profits to come outside of South Africa. So we're really more focused now, concentrating heavily on India and Mexico as our offshore operations. India really looking good. We turned EBITDA positive in October of last year and have maintained it. So really at that bottom of the hockey stick, and the next year very bullish. And of course, with the new setup in Mexico, we really believe that our vision in the next 3 or 4 years will come true.
For now, though, operations very much focused on South Africa. So let's take a look at that telecom space first, because competition within that telecoms arena is intensifying immensely. How does that environment affect a business like yours? I mean, to what extent do you consider that a threat?
I think without this coming across too bad, our setup in South Africa is really strong. We have competition in verticals. We don't really have that much competition in the horizontal. So we found our setup in South Africa to be really core to what we do. We're really strong in South Africa, and we see tremendous growth in South Africa, not only from the telco space, but products like prepaid electricity, money transfers, financial services, bill payments. For us, South Africa is really just beginning. So competition does exist. I think it's good for everybody. But I think Blue Label finds itself, we have over 140,000 points of presence in South Africa, which we touch almost daily. So really position ourselves well for many a year to come, and really bullish of the South African market in the space that we play.
Where competition does come through, though, and the competition that you've had to contend with, Mark, is within that SharePhone international side of things. I mean, revenues dropped back there, where you've seen a fall in competitive competitive edge, which payphones traditionally had over mobile phones. So run us through that landscape in particular.
Look, when we start our business, we look at a lot of different distribution channels, shared phone being one of them, which was a SIM-based application, which allowed us to offer a cheaper voice call or payphone through a mobile handset and a distribution point. As the tariffs decrease, so that model becomes less attractive, but other models become more attractive. So mobile wallets, mobile distribution, point-of-sale devices. Yes, so by all intensive purposes, we lost or losing a little bit on the share phone side, but really picking up the slack in all other places.
Well, would that mean that we're looking at a dying segment of the business in that regard?
I think that type of business, because tariffs have come down, the ability to convert handsets into payphones, that opportunity is demising daily. So yes, that side of the business is diminishing or decreasing.
While that diminishes, touch on very quickly for us some of the African opportunity, because that presents itself not only in the telecom space, on the electricity segment as well.
Look, most of our focus is now on the African continent, on South Africa. If you look at electricity, currently there are about 7 million meters deployed in the country. Government have intimated that they would like to double that by 2014. So as long as people are rolling out more meters and applying or providing more electricity to the masses, we can provision or the supply side of that by enabling these customers to purchase electricity a lot more conveniently. One wouldn't have to travel anymore. One literally could walk out of their house, walk 100 meters or 10 meters left or right, and have that convenience of buying. So that ability for us to take product to the consumer rather than consumer to the product is really boding well.